Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Is it possible to have a meaningful impact on communities and people and also make profits as a real estate investor? Today, my episode is going to tell you that the answer to that question is yes. And we've talked about it before, but this week we have Loren Jacobs of Arrows Capital Group, and we're going to talk about prioritizing people and impacting communities through real estate investing. Let's do it. This is episode 151 of Zen and the Art of Real Estate Investing with my guest, Loren Jacobs. Loren is the co-founder of Arrows Capital Group, where they are committed to placing people at the forefront of investments with a strategy designed to have a meaningful impact on the communities that they engage with. Loren, welcome to the show.
Thank you very much, Jonathan. Very excited to be here. I can tell that you've done that intro a few times. That was awesome.
Yeah, I wasn't practicing for yours, but I have done my own for a while since you are episode 151. But yeah, I'm glad you're here. And I love talking social impact and investing. So let me get your take on this to start. Do you think that there's some view out there that you can't make money in real estate and also have a social impact?
I absolutely think there is. I think there's a lot of stigma out there that as soon as, quote unquote, corporate buys or takes over or private equity or, whatever it may be, we kind of get stereotyped in that category. And that typically has a negative stigma along with it. And sometimes rightfully so. There are a lot of stories out there where big company will come in and churn everybody out, lay over their new systems and roll on, sometimes for better, sometimes not. We've seen some of that firsthand. And all too often what we find is that a lot of these investments for a lot of big firms are nothing more than numbers on a 2D spreadsheet. Yeah. And we like to look much deeper and ask ourselves the question during diligence, during our business plan development, and that acquisition stage is, how are all these decisions affecting the people behind the spreadsheet? We're talking about real lives. We're talking about people's jobs, their livelihoods, where they lay their heads down at night, perhaps seniors in a senior care facility.
Yeah.
There's a lot of people that are impacted by these decisions we make. And we are firm believers that you can prioritize both a return and prioritization of the people whose lives you're affecting.
Yeah, absolutely. I could take exactly what you said and boil it right down to a brand new investor who's just looking to buy a house from somebody off market. And the problem is that they're looking at it as a transaction instead of looking at just the one person of how can they help them get out of whatever problem they have in the house. You've obviously expanded it to a wider mission, but that can show that you can have a social impact if you're just really being a human and backing away from the spreadsheet, right?
Yeah, absolutely. I mean, there's opportunity anywhere as long as you're looking for that opportunity. For example, one of the first communities, the multifamily communities that we acquired, throwing down LVP and painting the walls isn't changing anyone's life. Maybe you get a few extra bucks in rent and it looks good on a spreadsheet and fair enough. Value add is a real strategy. But there's a lot more to it that, really doesn't have to affect the economics of the deal that much. We would put up, if you go around and you see sometimes there's little bookshelves around that's like, grab one, take one, leave one, take one, right?
Yeah.
So books, we've done some things where we've spent a couple $100 a month maybe on bringing in tutors to help children, there's all kinds of things. There's so many ways that you can economically give back and improve somebody's life without sacrificing the economics of a deal. And alternatively, what we find is that gesture typically does the opposite, usually putting that pay it forward foot down, giving first, giving more, giving often. That mindset typically comes back and pays more than it costs.
Yeah, I agree with that. I mean, if you just look at like a C- to D+ apartment complex with an owner operator who's not really taking care of it, and then they're complaining about the tenants, but why would the tenants be excited about living in a place that nobody's taking care of? So when you go the other way, like you're saying, you provide small amenities, big amenities, or community amenities, there's much more of a growing belief that, hey, whoever's running this isn't the target that everyone thinks. They're not a slumlord. They actually want to build community and hear our thoughts. I think that's really important. So how did you get there? When was the first time that you thought real estate was going to be something that you were involved in?
Oh, that's a good question. I come from a long family line of real estate, so I've had exposure to real estate for quite a while. My grandpa owns a real estate brokerage. My mom, a property management firm, and is an agent at the brokerage. Yeah. And they're both agents at the same time. So I saw a little bit of all of it. I, at a young age, got turned off pretty quickly by the agent side of things.
Yeah.
I just saw.
Well, also, it's like if your parents doing it, you're just like, meh. I mean, my dad was an investor and I resisted as much as I could. And then I was like, I mean, this is pretty cool.
Yeah, so. It takes a little while to come around, and you certainly want to carve your own path as a young rebel sometimes, which I was at times.
Yeah.
And but I saw the phone calls, I saw the emails at all hours of the night, all weekend long, all vacation long, and that was certainly a deterrent. As I got older, I got more exposure to the investment side of things, and that's really when it took off. I was super fortunate and had a ton of help along the way to be able to buy my first single-family rental in high school.
Oh,
and
awesome.
Got a lot of experience, did the whole self-management thing, had a little bit of help, but, wrote up the lease, did all the turnover myself, did all the cleanup, and, had to schedule the repairs and maintenance and all that stuff. So just really good experience. And from then, my wife, she was really of the same mindset, very entrepreneurial, very investment and business driven. So as soon as we got married, we started increasing. We did some fix and flips. We've bought more single family rentals. We'd BRRRR. We do all the different strategies and try all the different things.
Yeah.
And I was working a W-2 that it really wasn't fulfilling. I knew it didn't check all the boxes. We knew that we loved this real estate thing, and we saw the ability of the decisions we were making and how much impact they could have on a single life. We had one woman, single mom, 2 kids. Application was a little messy. Just, bawling, crying when we were talking to her on the phone. She needed a place to live. She was getting something or another, getting kicked out. And, we were able to work with her, put some things in place to, I guess, make that as safe of an opportunity as possible, but rolled the dice, helped this lady out. And it was just so rewarding to be able to help somebody, be in a position where you could help somebody. And so that's really where this idea incepted of, wow, that's really powerful. And this business is exciting, but the most exciting part is, being able to help people. And I mean, if you really boil it down, just leave the world a better place and show our kids and any legacy that we leave behind that, there's a better way. You can do good in the world and still do good at business.
Yeah, I think that's really the important distinction where we started. There's just this weird thing out there that, well, if you're making a lot of money in context, whatever a lot means to somebody, that you can't also be trying to do good. Like, you can be profitable, and maybe you do sacrifice a little bit of profit to do something extra. But like you said, long term, there's a bigger win down the road. Maybe you have much less vacancy, over time. So you have way less turnovers, way less potential evictions. And those are things that I think can't be quantified inside a spreadsheet, because you can't build community in a number box. And that's, again, what we talked about. I do think that on the larger scale, when you get into apartments and certainly with other businesses like assisted living, you look at the numbers on the spreadsheets to vet, is this financially viable? But then there's all these other things surrounding it that could increase the value and increase your life value of it. And this is obviously something that you took with you when you started Arrows, correct?
Yeah, absolutely. And, just to play off one of the points you made there, Jonathan, something that we didn't appreciate as much as we should have early in our journey and have come to appreciate significantly today is the culture of people, whether it's the culture of a resident base at a community. That's hard to underwrite. That's hard to perform.
Yeah, exactly.
And that is massively important to, do people want to live there? It's more than just being in a nice neighborhood near nice amenities. What's the culture of the people in place? And that plays into, are people paying on time? Are they paying at all? Are they taking care of your property? Do they like being there? Do they plan on renewing? Are they going to refer other people to this community? All the way to today, when we're acquiring a senior living facility, if we're acquiring 120 beds in the senior living space, opposed to 120 units in the multifamily space, you may be acquiring 2 or 3 staff. Over here in multifamily, in the senior living space, you're acquiring 120, 130 staff.
Yeah.
So the culture of the resident base is still important, but now you've got a whole new culture of the staff that's massively important. I mean, your business plan is based on these caregivers' ability and willingness to deliver strong, compassionate, quality care to these residents. And if that culture is out of whack, it's not a pretty sight. And it's not a quick fix to turn that around.
Yeah. And often, employees, especially in that space, employees may have different views on it than you as an owner operator, and certainly as the residents. The residents, some want to be there, some don't when it's elderly care, and some workers want to be there and some don't. That comes with any business with 100 employees. You're going to have a subset who would rather be doing something else.
Right.
So they begrudgingly do their job, and then that rolls over. How did you make that crossover, though, from multifamily, which is a little, is more of a management style, taking care of tenants, to something where there's a full running business involved underlying it with all those employees?
The decision really stemmed back from 2021, 2022. We saw the writing on the wall when we got into a second round of best and final on a beautiful multifamily asset in Nashville. And come to find out, there were still, double digits of groups bidding in the second round of best and final.
Right. Which there should never be a second round since it's best and final.
That was the first time I'd heard of that. And that's enough of that. We're not doing that ever again. So we started deep diving into alternative asset classes, commercial real estate asset classes. We looked at, storage, at parks, at car washes. We went pretty deep down the car wash rabbit hole, and lots of great asset classes, pros and cons to all of them. And we ended up landing on assisted living for a couple reasons. One, there's a high barrier to entry. So there's a moat around this space.
But which will detract on the whole best and final situation.
Yeah, right. Today, we're bidding typically against ourselves, maybe 1 or 2 other groups on a high, marketed, brokered opportunity.
Yeah.
But two other reasons, one being we knew an operator in the space that was very successful and very willing to mentor us, if you will, allow us to be a mentee, to watch and learn, look over the shoulder, answer any questions we had, kind of hold our hand as we learned, educated ourselves, and got started in the space. And third is, really able to expand on our mission. If people aren't laying their heads down in this place at night, that you're owning and operating, you don't have as much of an ability to positively impact their daily lives. With a car wash, with storage, for example.
Yeah.
You're not making a massive difference in someone's life if their car is dirty or clean. You can in multifamily, and really doubling down on that idea in the senior living space, because you're you're talking about a demographic that's so much more susceptible and really needs somebody in their corner. And the unfortunate reality is that there's starting to walk some of these facilities and going on diligence and site tours. There's a lot of ugly stuff going on behind closed doors.
Yeah.
And it's, so that's really become what our mission is morphed into, to take as many of these facilities and just improve the operations, improve the culture of the staff, improve the ability of this asset to deliver high quality care to residents that deserve it.
Yeah, I think one thing that people forget also is it's not, you have your employees, like we were saying, and then you have your residents, you have yourselves owning and operating the business. But if you're running assisted care really well, it's the people who had to put their family there that gets the peace of mind that is, you can't quantify ever, because it's so hard for somebody to decide, hey, I have to put my parent in assisted living, or somebody has a physical limitation, that if that's also not going well, like I don't know how anybody gets through that. It just sounds like, so there's such a good trickle down effect by turning around a facility, which, in multifamily we would call value add, but it's value community care add in assisted living. Are you seeing that as well, where you have the family saying like, wow, this is such an upgrade, this is much better, and then they can breathe a little bit easier at night, even though it's not, the perfect situation, it's just one that needs to occur for some people?
Yeah, absolutely. That's the goal. And funny enough, you mentioned that. That's where a lot of when you're underwriting or analyzing a supply demand analysis in the senior living space, a lot of what you're looking for is that, maybe 45 to 65 demographic, because those are typically the children of individuals who are being placed in these senior living facilities. And they typically want to stay close to home. They want to stay close to what's familiar. They want to stick close to family. And being able to provide peace of mind to family, to a resident, to family, to a POA, a power of attorney, or whoever is making the decision is the ultimate goal. And that's when you're doing good, you're doing your job, when you get raving reviews, people are happy, they switch from one facility to another, which happens sometimes. We'll accept residents from another facility. Typically, when a resident moves into a senior care facility, they move out for one of three reasons. Number one, their needs have increased beyond a degree that the facility is willing to, or able to provide, or licensed to provide. Number two is that the facility it's not a good spot. Their care is not being delivered adequately or well. Something has gone awry, and they want to move. And that's really bad, because you don't want to move more than you absolutely have to anytime, let alone at 80, 85, 90 years old. Your family's got it. So it's a mess. And that's a really bad sign. If you have an assisted living facility, a senior living community, and you have residents moving out, that's a red flag. So sometimes we'll accept those residents in, and just to hear some of those stories of, wow, here's the contrast, here's the differences. Thank you. That's why we do what we do. And it's tremendous. And the third reason people move out is because in this business, they pass on, or they move on, or as I like to say, they graduate from this world.
Yeah, that makes sense. Let's pivot a little bit to underwriting, because we haven't had an assisted living show. This is a great kind of intro into it. And there also is, of course, the financial aspect. You're not going to buy something that's going to soak you, as an operator. So demographic research and financials, what are some key things to look for if you're looking at assisted living?
Absolutely. So a core basis in a fundamental ability to underwrite commercial real estate is a must, because this is commercial real estate. It's multifamily with a healthcare business layered over top.
Yeah.
So you certainly need a basis of being able to underwrite commercial real estate. having some familiarity with corporate finance, if you will, or how to underwrite a business is very important as well. But you can learn. Probably the best thing that I would do is look at this as if you're looking at multifamily, and then you would see specific line items, right? So you're going to need to learn the nuance of the line items that are different here with the care business versus multifamily. So have all your multifamily line items, plus you're going to have a pretty substantial payroll, labor and wages, overtime, FICA, health benefits, payroll taxes, all that stuff that falls under payroll. You'll have food, you need, and medical supplies. You need all the supplies to feed these residents. You need all the supplies to care for them. Understanding that model is just so important. And just like you go to learn anything, I mean, there's lots of places you can go to learn. I had a really tough time getting into the space, learning underwriting, because there's not a lot out there years and years ago. Now there's a lot of groups, there's a lot of masterminds or courses or what have you to go watch and learn. Some of the nuances that we look for are typically going to be, we'll call them value add here as well, but they're not the same value add that you would see in a multifamily space. So the value add that I'm talking about would be, it's not terribly uncommon to see 90, 95% operating expense ratios in the senior living space. And
wow.
That's one of two things is going on. Income is really low or expenses are really high. Again, both of which are common.
Yeah.
So we'll look for the ability to improve the financial operations and add value that way. Typically, we can go in, we've built out some proprietary management systems that have cut down expenses quite a bit. So pretty early on in our senior living journey, we figured out that third-party management is not a viable, long-term, and scalable solution.
Yeah.
You just can't align incentives well enough to make somebody else care as much as you do. So we brought the management component in-house. With that, we've built out some management systems that will help us automate scheduling. I mean, you'd be amazed at how many of these folks are still running on pen and paper. Pen and paper scheduling, pen and paper.
Yeah.
I mean, cutting checks out of an old checkbook for payroll. It's wild.
Well, that's a mom and pop operator mentality. You see it a lot in self-storage on the lower end, and certainly in other things. But this is a whole business as well. I guess though, the more you look at, the more you can quickly identify where the value add is. Like I would assume if you could walk into a mom and pop facility now, where it's not a conglomerate, you can immediately see what's wrong with it when they pull out a checkbook, because it's inefficient. So what else is inefficient, including food ordering, food delivery? There has to be huge food overage for a lot of places because they're not good at ordering because their systems aren't up to date, right?
Not good at ordering. The procurement systems are just not in place or present. Food waste is a big one. Are they over preparing meals? Are they, what are they doing with leftovers? Are they utilizing leftovers? Where are they getting food from? So there's a lot of opportunity for somebody to come in who's willing to systematize operations, has the ability to systemize operations. And, I know we mentioned this earlier, and it's hard to underwrite, but going in and seeing ineffective culture or just getting a sense, you can walk into a place and maybe there's a smell,
Yes.
maybe there's an odor, or you can just feel a bad aura, a bad vibe.
Yeah.
That says a lot. And don't let those little gut instincts that you feel go away. I mean, those are meaningful. So yeah, to get back to your question on the underwriting, there is a lot of nuance. Occupancy is typically a little lower, which can be normal because it turnover just happens naturally. Expense ratio is typically higher. And once you familiarize yourself with the nuance of the P&L, how the income state differs from multifamily, and what some norms are, it's really very similar. And one thing that I would say that helped me a lot when I was cutting my teeth and underwriting multifamily is, you just have to get out there and underwrite a ton of deals, connect with a lot of industry experts, and see if you can get behind some closed doors of folks who are operating deals, being able to look at their financials, go underwrite the deal and now compare it to their actual performance. And you'll start to be able to trend, okay, here's where different line items should fall. Okay, this looks really high in this market for this size class of asset in this area. I think we should be able to normalize this. That's how we've approached underwriting, and it's been able to help us identify a lot of value that maybe others have not, is being able to normalize that income statement.
Yeah, but going back to something you said before, this isn't a highest and best where you have 20 bidders. So really, your due diligence can be a little bit more drawn out because you're really trying to find the win-win. But the way that I look at it is, you really are trying to identify like what numbers are they missing. Because I know from mom and pop self-storage, it's like they're not counting certain things because they've always done it that way. And you're like, well, we're going to do that, so we have to add that on.
Right.
And I think that's a really important mechanism. And that, as you said, you can really only get that with taking reps and hopefully seeing, because if you've never operated a business at this scale in healthcare, you're not going to know all the components that should be charged. So you could look at a balance sheet and stuff could be missing, could be on another, a whole nother sheet, and you just could miss it and just assume that the numbers are correct.
100%. There's another big key component that we'll look for are these add backs that an owner or a broker doesn't catch. Owner salaries, personal vehicle expenses, other write-offs that people slip into, a P&L or a tax return. Rent, there's still a lot of triple net leases, operator triple net leasing real estate. And, being able to just understand how to bypass those and normalize that to be able to model your business plan. Exactly. And another thing that's really attractive about the space is, we're not competing to buy an asset at a 4.5 or 5 cap. We're typically acquiring stabilized assets between a 9 and 11 cap.
Wow, that's good comparatively, just because people know the other markets, how compressed the caps have been in multifamily.
Exactly. So a well-operated facility generally will yield significantly higher NOI per unit than traditional multifamily. And therefore, cash flow is stronger, which ultimately makes an investment lower risk. It mitigates risk of being in a cash pinch or a lot of what you're seeing out there today.
Hey, it's Jonathan. On this brief interlude, I want to give you an update because our new website has launched. zenandtheartofrealestateinvesting.com is live, and you can go there and check it out. I really want you to go check it out because we're going to still be upgrading more, but it's going pretty well so far. This is a very guest-focused podcast website. Each guest has their own profile with their own links to our 10-minute clips on YouTube, and also links to the episode. You can search for guests using the alphabet, or you can search in the search bar. Soon we're going to have tags up as well so that you can search in certain categories: short-term rentals, mid-term rentals, syndicators, multifamily, and then you'll be able to link to the episodes on that. I have really put a lot of time into working with my team to get this website to be extremely visitor-friendly and very guest-friendly. I hope you enjoy it. At zenandtheartofrealestateinvesting.com, let's get back to the show. I have a question for you. It's kind of interesting to me because I'm thinking about it. The business is really running the inside of this, but there's real estate underneath it. If you have to consider it, like, what's the percentage of detail to the actual real estate? Like, what happens if one day you don't, the assisted living doesn't work? You still have the real estate to repurpose the building into something else. So how much does that asset, the actual real estate underneath and the building, come into play while you're also doing due diligence just on the business? Because those really seem like two separate but intertwined things.
It is. And I view it it's a little bit like a church. You think here's this big, beautiful building. It's got to have a lot of value, even not as a church, but it's so unique in its architecture, its design and structure that it typically doesn't bode well for many other business plans. So, you're stuck with a valuation of an appraiser will use typically what's the highest and best use.
Right.
For these types of facilities, they're being used for their highest and best use currently, typically, unless there's another business plan that I'm not aware of that might perform better in these facilities.
Well, yeah, that makes a lot of sense because you can't just take, okay, great, we have all this real estate. We'll just make it apartments. Like, that's not how it's set up.
Right.
It's not set up for apartments. There's not bathroom in every single, unit. That's where that makes a lot of sense.
Yeah. So if you're buying a vacant building, you have a little more optionality. And we're starting to look at that now. There are a lot of facilities across the board that are getting closed down or not being operated well, or a mom and pop or just, have to close the doors. And so we're starting to look at, how can we take advantage of some of these vacant buildings? And in our business model, it typically makes the most sense to acquire them at a discount and just roll the same operations back out with, our improvements and efficiencies layered on top.
Yeah. And that's where you do the value add on the real estate portion before, and then you bring in the systems, and then the people. But when you're doing that, if you're buying a vacant building, then again, I immediately think demographic for self-storage. Is this something where you're looking how many other facilities are in the area within a certain mileage to see what the opportunity for filling your beds are?
Absolutely. So I mentioned a supply-demand analysis earlier. We'll perform that on each of the facilities that we're underwriting or looking at. And basically, you're looking at how many residents in the demographic of needing assistance in senior living are in this area. There's what's called a penetration rate, which is an estimate on how many of those individuals are actually going to seek living in a senior care community. Yeah. And then we'll identify how many available units for assisted living, for memory care are available today in this geographic area. And then can identify, is there a surplus? What might an absorption rate be for something like this, and go down that path. And then we can even extrapolate, a future estimate. So yes, it we'll dive pretty deep into that analysis, and it's not so different from multifamily. You're just targeting a different demographic.
Yeah. And geographically, are you, all of the things that you're acquiring, are they all near Nashville or around there? Or have you expanded outside to find other markets?
Yeah. So we're based out of Nashville. Our assisted living portfolio is actually in the southern half of Wisconsin. So really southeastern quadrant of Wisconsin, not in Milwaukee.
Yeah. Okay. How did you end up with that opportunity presented itself, and that's just happened to be where it was?
That happened to be where the first assisted living community was that we acquired, and then we just expanded from there. So we found another and another. Now we brought management in-house, so it makes sense to keep everything in proximity for a while until we reach scale, and we're starting to talk about expanding to other markets and states.
Yeah, I think it's important what you said before about going to vertical integration, because outsourcing things comes with problems. And if you're talking about community and healthcare, the more you outsource, the more disconnected from the actual source it can be. That's something, I guess, that you found out early. And then going vertical, even when you go vertical in multifamily, it's like, okay, well, now you have people on site. That's super helpful when you have 150 units instead of having to call somebody.
Right. And, not to downplay multifamily, because it is a great business. And, we still have multifamily in the portfolio. But management in multifamily is much different. You can find a third-party manager that will adequately manage an asset. And there are some good ones out there. generally overseeing a leasing agent, maybe maintenance tech. The leasing agent is signing leases, doing a little bit of marketing. Maintenance tech is dealing with repair calls or work orders. Much different in the assisted living space. Much more intensive, much more cumbersome, and there's a lot of regulatory pressure and oversight.
Yeah,
So it's a lot to ask a property manager to go manage an entire facility for 5 or 6%. And it's just, we haven't found that you've been able to align incentives enough for them to care enough to be truly effective.
Well, so going vertical, though, then it gives you the incentive because it's all part of what you're running. So that kind of helps you pay more attention to it than an outsider would.
Exactly. So even if that fee is now essentially a pass-through, it's not a huge revenue generator. But even as a pass-through, you've got a direct line of sight from top to bottom. You've got full control, and you can now dictate the outcome much more effectively than you can with a third party in between you and the outcome, essentially.
Yeah. So going back, how did you go from, starting to do this investment? You figure it out, you and your wife start flipping. How do you eventually get to Arrows Capital and decide like, hey, this is what we want to do. We do want to operate with other people's money. How did you get to that point in your journey?
Good question. That was a big jump. Skipped that part.
That's what I'm here for.
So I mentioned the W-2 that was not fulfilling. I talked to my wife right around the time we found out she was pregnant with our first child. We had a talk and said, hey, what do we want the rest of our lives to look like? How do we want to raise our kids? What is that? What's it going to be? And I didn't want to work at a W-2 for the rest of my time. We both loved real estate. We saw the power of it, but we also knew that, we weren't scaling fast enough. We couldn't save fast enough to buy enough rental properties to, be able to trade out of that W-2 in any short-term time frame. So we agreed that we wanted to find a solution, and we kind of agreed generally on the path that we wanted to trend down. We just didn't know how to get there quite yet. So I dove into all the books, all the podcasts, went to a bunch of conferences and seminars, and I was finally listening to a podcast, and they mentioned on the podcast, you need money, you need capital to buy real estate, but it doesn't have to be your money. And that was the first time it had really clicked to me. I'd heard of OPM, other people's money. I'd always associated that with, using a bank, using leverage to buy property. But I never really put together that the equity could also be other people's money. And that really opened up my mind to JVs, to syndications, to funds, and all that whole realm of other people's money using other people's money as an investment tool and managing that investment and making a living from doing so. And I just couldn't get enough of it. So for the next year or two,
well, it's the bridge to getting further while also bringing people along with you. But if I think back, my dad was a cash investor, so I was kind of didn't really get mortgages when I was younger. I was a cash investor up until my 30s. And then I was like, oh, okay, leverage is starting to make sense now. But I'm still uncomfortable with leverage. So then when I think myself about, other people's money, I'm like, I could be a great steward for other people's money because I'm really tight. But there's just something inside of me that's also scared of it, that I almost don't want the responsibility because people can be annoying. I'm not necessarily a people person. And that's where syndication set a good scale with GPLP because kind of you're going to be a little bit more silent down there, hopefully. How did you get through that? Because I think that's a big thing that is the crossover to doing it. And then actually, okay, we just accepted somebody's money. Now we have to be a good steward.
Yeah. So as I was learning the syndication path, the JV path, I realized I needed to add enough value to a team, to a partnership, to be able to earn a spot into that team. And there's a couple ways you can do that I identified. You can bring a deal, you can bring money, your own or somebody else's. You can KP. Maybe you can put up some at-risk capital or a combination of the above. I didn't have a large balance sheet at the time. I didn't have a bunch of excess liquidity. I didn't have a Rolodex of high net worth investors. So I was stuck with finding and underwriting deals.
Yeah.
So I got a coach, got somebody to help mentor me. Told me to go get as good as you can at underwriting deals and become a professional networker. So I did the best I could at those two things. At first, I think the switch was easier for me because I got into my first opportunity as a general partner by underwriting a deal, performing diligence, helping with asset management. I wasn't bringing in my grandma's life savings to a deal,
Right.
So that helped dip my toes in the water. I learned a ton. And as I learned more, became more confident and, just garnered more skills and became more capable, it helped me get over that ability of, hey, I can go reach out to people and start to raise capital and invest. And even on good days, like it is, we don't take that fiduciary responsibility lightly. And it can be unrelentingly stressful on a good day when you've got millions of dollars of other people's money that are riding the coattails of the decisions that you make. It's certainly not for the faint of heart, and it's not for a weekend warrior. It's not for somebody who isn't willing to, I guess, pull out of their pocket before they're willing to lose somebody else's dollar. And
that's very important to me, especially when I was, learning more about syndications as I got older and really figuring it out. I was like, oh, skin in the game. Obviously the operator is number one for me, and then skin in the game. Because if the operator has no money in it, why am I in it? It doesn't make that much sense to me. But there's a good juxtaposition for something you said, because you said the first one that you got in by vetting the deal and bringing the deal, so you didn't have capital in, which again is great. You don't have the pressure of, like you said, grandma's money, but your due diligence is the thing that the deal is built upon. So there is another different kind of level of pressure at that, and maybe even more so because you don't have the capital. So that means like you have to get really good at the due diligence.
Right.
Right.
So another piece I should have prefaced with is, I didn't go at that alone. I was not the lead operator. I was not the lead sponsor. I had somebody with a lot of experience leading the charge and who was gracious enough to. How I got my foot in the door in this space is I learned as much about underwriting as I could. And I connected with all these operators out there doing deals as I could. And I would offer to underwrite their deals for them for free. I'd underwrite
free reps for you, right?
Free reps for me, free feedback for me, free underwritten deals for them, which increased in quality over time. And, eventually all I would ask is like, hey, if you go get an LOI, if you put this under contract, if you're going to go close, just give me an opportunity to add some value and get a piece, see something, see behind the doors, get some experience. And eventually, we got something that landed, and, but I was riding the coattails of a lot of experience. So it certainly was not riding on my underwriting alone.
Yeah, but I mean, you got yourself in the door. And I think when I talk to what I call baby flippers, who are like first-time house flippers, and you'll remember this back from your journey, they always say, well, I'm going to go flip a house. I'm like, you don't know what you're doing, so why would you do it? The best solution is to be a very tiny JV partner with a really experienced flipper. It doesn't matter if you have 5,000, 10,000, just get in the deal. Even if you put 10,000 in and you get 11,000 back, and you can see, like you said, behind the door and get everything. That's magic. That's such a smarter first move than like if you were to go into this and say, well, I'll just bring like 200 grand and just plop it in because I really want to be in this deal, but I don't really know what I'm doing. And I think that's where you can see how real estate is actually also similar, because we're talking about large scale apartments generally. but you can boil it right back down to a first-time flipper thinking the same thing. How do I get in the deal if I don't know what I'm doing? You have to bring your skill set. Sometimes the skill set is time. Yours was you're going to learn everything you can about underwriting. And the first one was probably like not as good as the 10th one, like you said.
Oh, no, the first one was a mess. I don't want to think about that one too much.
Yeah, but that's why you offer to do it for free, so you can learn and then you can get feedback. And I think that's really important. People who haven't built up the relationship or skills to get in the door, who just knock at the door, no one's going to answer.
Yeah,
Just, there's no reason for them to answer until you can bring something to the table, which was, options and help on a deal. And then that grows as you go, right?
Yeah, absolutely. I'm fortunate enough to be able to do a little bit of coaching in the space for people trying to get into commercial real estate. And one of the things I always preach is, this, when you're first starting out, this is learning season. This is not earning season. You push that idea down the road.
Those two aren't very close together.
No. You'll learn as much as you can. Do what other people won't do. Work for free. Do whatever you have to do to go learn. And that the ROI on that education is going to be far superior to any ROI that you're going to get on any single deal that you may or may not do.
I think that working for free is probably the most underrated thing that anyone could ever do. And we're in a culture where now, the pandemic changed a lot of things. So people are like, well, it's not really worth my time. It's like, well, you can't get in the door if you don't throw something in there. And I remember when I was like when I was 15 working at a job, I didn't care what I got paid. I would get like a check for $5 an hour for a week. And I was like, wow. But then the next they were like, wow, you did a really good job. Now you get $6 an hour. I'm like, that's a lot. And I think that scale of being able to like show up and do it for free and prove your value, that's what makes people rely on you, instead of coming in with your hand out and saying, I'll do it, but it's going to be X amount. They don't even know you. Why are they going to pay you?
Right. Another thing I add on to that idea is, don't come to somebody and just say, hey, I'll work for you for free. What can I do? Come with a little more thoughtful and meaningful offer. If I just said, hey, Jonathan, I want to learn podcasting. Let me work for you for free. I'm making it all about me. It's not about you. Like you don't know what skills I have. I don't really know much about podcasting, so I wouldn't be much help.
Well, you're trying to find where their deficiencies are and see if that matches up with any of your skill sets, right?
100%. If I came with a slightly different offer and said something along the lines of, hey, Jonathan, I've been spending the last 60 days learning as much as I can about editing podcasts and the software stack, and here's some efficiencies I'm able to be able to bring. I'm happy to do anything I can to help save you time and add value to you and your business. Is there anything that I could do to help you? And I'm willing to work for free. Totally different offer, right? Like, which one are you more likely to respond to?
Yeah. I think, if you go back to like an Alex Hormozy principle with your Grand Slam offer, you want an offer that somebody can't refuse. And if you're offering something for free that's of value to them, why are they going to say no? Unless they think you're like trying to steal stuff. If you're a reputable person and you come to the table, like you said, and I've gone through your website, I've looked through all the documents that you sent me. Here's where it looks like a hole. If I'm correct, this is where I think I can add value. And I'll do it for 2 months for free. And then we can sit down and talk like if that was valuable. Why would they say no?
Yeah.
I mean, it's a no brainer, but you're really good point, because I talk about it a lot. It's nice to offer yourself to somebody, but it's work for me if somebody comes to me and like, what can I help you with? I'm like, I don't know. That I don't have the time to even figure that out. Exactly. So it's like, that's the cycle of business. And that's where I think that just knowing this part of our conversation can help people get to the mentor so much quicker, don't you think? Because the ask for a mentor is one thing, but then doing the due diligence to figure out, hey, where you can be of value to each person is going to be different. If you know that and you present something that's how could someone not say no to this, you're 100 times ahead of everyone, which means they're going to appreciate you more. And I've always said if you show up all the time to something, your mentor will appear. Based on your experience, do you agree with that?
Show up and show up prepared.
Yeah, I didn't mean show. Yes, please be prepared, conscious, and communicative and interested in other people.
Yeah. So I've had a couple people reach out before, and a couple folks will be more like, hey, what can I do for free? Or, hey, how do I buy my first multifamily property? The ones that I typically will respond to and will take a lot of time to respond to, because I generally do enjoy helping. And most people that I know who have achieved any degree of success are excited to extend a helping hand or to be a mentor of some sort.
Yeah.
They're excited to talk about what they've done and how they've gotten where they are. The ones that I'll respond to are typically the ones that come and say, hey, here's what I've been doing for the last 30 days. Here's how I found this opportunity. Here's everything I've done to underwrite and to take a look at it. I've got a few questions. Do you mind helping me out? Or something like that. I'm like, wow, okay, you've been doing a lot of
They've
work.
done the work.
You're showing up prepared. I've got a lot of respect for that. Yeah, I would love to help you out. But yeah, I totally agree with you. There are folks that will take your time, and there are folks that will save you time. And
exactly,
we're far more likely to, I guess, give time of day to somebody who's willing to save us time and to put in the work and put in the effort.
Yeah, that's really important. I mean, you can frame it out. I've done X, Y, Z. Here are my 2 questions. And that's not overwhelming for somebody.
Right.
That's what I appreciate too. I want it well thought out and very curated. So I don't have to, I want the 15-minute meeting to take 7 minutes if I can. It will take 2 if someone will just text me the questions and I can see the stuff. They have to be cognizant of, what's in it for everybody as a win-win.
Right.
That's a really important part. And I think it sums up kind of the way that you think about real estate in general, as you want it to be this thing that everybody can hopefully make money from, but that there's an ulterior social benefit to it as well.
Absolutely. And I just think it comes back to this principle that we just talked about. But having a fundamental quality of, servant leadership or serving first, serving more, it just comes back around. I'm a firm believer of that. I've seen it in action. Not that, I serve first with the expectation of receiving, but serve first without that expectation. And more often than not, it'll come back to benefit you. And we've seen that so much in our business. And it really plays out in the senior living space.
Yeah.
Sometimes I'll have people ask, how do you prioritize profit versus care, like quality care to the residents? I'm like, I don't. I prioritize them both, because you actually have to have them both. And being on this side of the equation, it makes perfect sense. But I can also see how somebody who has not had the purview of, or the vantage of this side of the equation may not see that, which is, if I'm not offering quality care and I'm skimping out on payroll and I'm not paying caregivers very well, and we're cheap on food and the quality of food that we're preparing and providing, how solid do you think our pipeline is going to be of residents that are willing to pay premium rates?
Yeah.
What do you think our brand reputation is going to start to become in the community? Do you think people are going to be excited to refer friends and family and loved ones and their mom and dad, and with that brand reputation? Like, it just boils down, and it's not an immediate response, but it's a slow response over a long period of time. But in the end, it's you have both or you have neither, in my opinion.
Yeah. I can see where people could lose in this space by thinking, well, there's not a better place to go. That's not saying like, hey, we want to be the best place. It's just saying you're better than the worst place, which is a terrible business model.
In most places, we are so underserved in our supply of senior care facilities that's typically not the problem.
Yeah.
If you have an older facility, maybe a 90s build facility, and right next door pops up a brand new 2024 beautiful facility, like, you're going to have some trouble. That's typically not what's going on in the space. Usually you've got similar products in similar areas, and you have maybe one that provides really quality service and most that don't.
Yeah. Makes sense. Awesome. Great overview on the two asset classes as well. Where's the best place for people to get in touch with you? Is it at arrowscapitalgroup.com?
Yes, that would be the best place to check us out. My email is best for me. I'm on Facebook, X these days, and Instagram, but I'm in my inbox. You'll catch me quickest in my inbox.
And they can find that through the website?
Yep, it'll be on the website, or it's Loren, Loren .Jacobs at arrowscapitalgroup.com.
Awesome. Well, great job. I appreciate the time and glad that I got you on and we worked out our scheduling. Yeah. It's been a pleasure.
Likewise. Thank you so much. Appreciate you, Jonathan. Appreciate allowing me to be here. This has been a bunch of fun, and I hope it brings your listeners some value.
Yeah, me too. And I know it will. Appreciate your time. That was Loren Jacobs of Arrows Capital Group. I'm Jonathan Green. We'll see you next episode. Wait, you have reached the end of the show. This is the part where you're going to get ready to check out, but I've actually changed this part. For over 120 episodes, you heard the same thing. Well, now I've changed it. I've thought about doing intros to the next episode, but I'm going to hold off on that for now. These are my pitches at the end. I've got nothing to sell you at all, but I do want to remind you that it really would help us if you support the podcast in the right way. All that means is subscribing to the podcast so you get it on Monday and Thursday, writing us a 5-star review if you believe that we deserve a 5-star review, sharing it with your friends, and being a participant in the Zen and the Art of Real Estate Investing community. Soon there's going to be a new website launched. Maybe when you're listening to this, it's already going to be out there. That's where we're going to have collaboration. You're going to be able to see a lot from the guest. It is coming soon, and I just want to tell you, from me to you, I don't know how I got here, over 100 episodes. I'm so appreciative of you listening to the podcast and especially sticking around to hear this part. We'll see you next episode.